Hey, this is Don Kaufman reminding each and every one of you, please visit TheoTrade.com/live. Again, it's TheoTrade.com/live. This will gain you access to the return of the trader event live here in Scottsdale, Arizona, May 3rd through the 5th. Allow me to take you through a little bit of the schedule. Again, VIP tickets are sold out. First tier seats are sold out. Okay. Add to cart. The entire 2.5-day session is $1,100. Okay. Again, let me go through the schedule. That event's going to be held live here in Scottsdale, Arizona. You must get tickets for this early. Of course, many of you are going to have to book flights. Okay. We've got a great rate at one of the nicer hotels here in Scottsdale. Anyway, first and foremost, on May 3rd, we're going to host an evening event called Cocktails and Trading, a little bit of a party, but we're also going to have, okay, what we call Technical Analysts Meets the Quant Geek. So we're going to actually have Jeff Bierman and Don Kaufman, myself. Jeff and I are going to go at it with our what we call respective positions. For those of you who do not know this, Jeff Bierman, the former chief market technician for TD Ameritrade, will go against me live and uncut. So it's the technical analyst meets the quantitative trader. That'll be kind of the main event on Thursday evening as we kick this event off. On Friday, we have a little bit of an opening ceremonies, and then we get to the actual topics of the day, including return of the trader, negotiating intraday volatility shifts. That's actually Professor Jeff Bierman. Perfecting your Nasdaq and intraday trading style with Tony Rago, a fractal analysis intensive from Doc Severson, taming the trading day from Corey Rosenblum. All of that, people, okay, is on Friday. On Saturday, probability and profitability in trading. That'll be my session to kick off the day. A price action intensive from Doc Severson. Intraday trading and Nasdaq E-minis, which of course is going to be Tony Rago. The state of the markets address and creating your game plan for the next day of trading, followed by, again, a lot of Q&A and kind of a great send-off at this event. It is 2.5 packed days, everything from a cocktail party, plenty of time to kind of meet and greet some of the instructors here at TheoTrade. Please visit TheoTrade.com/live. Now, let's get you to the evening video. Welcome to TheoTrade. This is Don Kaufman. It's March 7th, 2018. You are watching the Theo Night video just moments after the cash close. Let's first and foremost recap really the last day of trade with the futures gapping pretty massively on the resignation news of one of the top economic advisors. What we saw throughout the course of the trading session and overnight session, however, is a rally back to, well, where the S&P futures currently are, which is massively unchanged. So volatility continues to kind of, reign large in the broader market. In a time like this, though, when you're looking at the S&Ps, and let's look a little further than just some of the action on an intraday basis, but let's actually back this up to a 30-day, 1 hour, and look ultimately at what everybody is describing as volatility. But you have to recognize that really, by and large, we're just channeling inside of still a relatively tight range. The only differential right now from what we've seen over a lot of recent years is, I mean, come on, people, we're seeing like, 40, 50 point moves every single day inside of the S&P futures. Again, to kind of quantify this a little bit, this is in the overnight session. We're trading, 2680 in the S&P futures. We close out the day right where we currently are there at 2723. I mean, again, 40, 50, even 60 point ranges have been seen day in and day out. Need I remind you that, again, this is just on Monday, ultimately Tuesday, one of the tighter ranges, other than, of course, that massive gap down. And you go back and you're seeing this time and time again. Now, time out for just a second. You got to start to get your risk in check when the market allows you to do so. So with all of this going on, and again, we're seeing us channeling back and forth, but the ranges on a day-to-day basis are fairly substantial. You have to, again, kind of breathe deeply. Let's zoom out for a second and recognize this range isn't likely to hold here much longer. Now, of course, everybody's question is, are we heading up and heading down? I'll talk about that here momentarily because there's some pricing in the volatility world that does give you a little bit of an answer on that front. Nevertheless, before we get there, okay, when I say let's just get our risk in check, one of the things that I want to show you that's to me a little bit alarming regarding markets is take a look at either the S&P futures or the Nasdaq futures. Now, some of you that join us here on a day-to-day basis, you might not trade on an intraday basis, and that's okay. Like I sit here for 6-7 hours a day, and we're scalping back and forth, filling a couple trades here or there, putting on some new longer duration positions, putting on some spreads. Okay, I trade a lot throughout the course of the day, but in the midst of doing that, there's one thing that really kind of caught me in the last few days and it kind of surprised me, and I want to show it to you. Again, regardless if you're trading futures or not, I want you to look at some of the margin requirements, okay, of the futures contracts. Now, some of you, again, may or may not be familiar with this, but when you start looking at the margin requirements of the futures contracts, the E-mini S&P contract is now trading $6,380 in the overnight margin requirement. You're like, okay, so what does that mean? First and foremost, that margin requirement has increased significantly, but it's not the S&Ps that I really wanted to focus on for a moment. I wanted to take a minute and look at the Nasdaq requirement because the Nasdaq requirement has gone to $7,700. Now, again, you don't necessarily trade on an intraday basis. You're thinking this doesn't necessarily impact me. Absolutely, it does. Allow me to show you why. So the margin requirement for a Nasdaq future is $7,700. Now, let me show you why this matters for everybody. If you take a look at the net change, okay, it's about $18 today for the Nasdaq future. Now, if you've never traded a Nasdaq future, again, fine. For every 1 point that the Nasdaq future moves. Now, let's kind of script this up here for a second. So for every 1 point the Nasdaq future moves, you would make or lose, okay, $20. So that's always confusing to people that don't necessarily trade futures contracts. So for every 1 point, okay, that this Nasdaq future moves, and the Nasdaq future is currently trading at 69.25 and change, you're going to make or lose $20, okay? Now, the reason that this is important, I want you to take the margin requirement of $7,700 and I want you to divide it by 20. Okay, why? Because that'll give us effectively the number of points that the margin requirement is, well, requiring right now. And what I'm saying is that is equivalent to 385 points. Okay, time out for a second. What the margin requirement is based on, the overnight margin requirement in the Nasdaq futures, that's actually what we call span margining. And it's approximately, all right, 3 times the standard deviation. So right now, that's the exchanges are kind of dictating that you should have higher margin requirements being held. Obviously, there's some more volatility in today's marketplace, but what $7,700 equates to is as much as a 385 point move inside of the Nasdaq futures. Now, if you're not familiar with the Nasdaq futures, maybe the QQQ would do it for you. The Qs, can you imagine the size of the moves that you would see inside of the Qs, given the fact that the Nasdaq right now, a 385 point move. Now, again, I want to clarify and quantify that it doesn't say that the Nasdaq is going to move 385 points. It simply says, well, that's the overnight margin requirement because there's increased volatility. And this is a time where, you have to kind of stand back from the market and go, this is like, I better get my ducks in a row because, well, even the exchanges are telling you to do so, and that is why they're holding larger margin requirements. So if you start looking at stuff like the Dow futures, the Dow futures, for every 1 point that the Dow futures move, you make or lose $5. Their margin requirement right now is what? 5,800. Well, granted, we've already seen over a 1,000 point move inside of the Dow. Okay, and well, we saw that just recently. So again, the Dow margin requirement is right where it should be. The Nasdaq margin, requirement is right where it should be. And there's times where really looking at the futures margin requirements can kind of help you, well, qualify, quantify, and sometimes make you feel sick to your stomach regarding your risk. But I wanted to take a minute on an evening video and do this and kind of take you through this exercise, because this isn't just, somebody yapping at you saying like, hey, this is your risk. These are exchange margin requirements screaming at you, get your risk in check. Now, with that, let's look at the next couple of days of trade inside of the S&P. So everybody's looking. Are we going bullish or are we going bearish? One thing, there's been quite a bit of negative news, okay, in the last 24 hours. However, all that negative news, all right, the market has been incredibly resilient. So here's the huge gap down. We rallied back out of the hole. We're exactly where we were yesterday. So what have we gotten to? Massively unchanged in the last 24 hours. Okay, so what's the forward look over here? One of the things that I've been looking at extensively for bias on a day-to-day basis happens to be none other than the dollar. If the dollar starts to rally up, like if you're seeing the dollar rally tomorrow morning, okay, which is Thursday or Friday morning, you're probably going to have yourself some sell side activity in the S&Ps. Okay, now a lot of what this is going to come down to in the next 24 to 48 hours, unfortunately, is going to be hinged substantially upon the jobs report that'll be out on Friday. Nevertheless, I think the dollar is an excellent indication right now, okay, of overall market move and market momentum. So again, I want to quantify what I said here. If the dollar starts to rally back, which, in the overnight hours, there's some moves. There's going to be a lot of headline risk in the very near future. There's going to be a retaliation possibly for what maybe are going to be some tariffs on steel and aluminum. We'll see. Okay, we'll see what some of the retaliation happens to be. Nevertheless, the dollar moving up is probably indicative of the S&Ps heading back down. As I said, though, there's going to be a market filled with headline risk, not just, again, the jobs number or the retaliation. There's constant headline risk that's been hitting us. Specifically today, we even had an oil inventory report today that rocked markets kind of midday back to the downside. And for those of you that are unaware, what created some intraday volatility today, that was right here, was the oil inventory report that came out. The market initially reacted positively, then dove down. But this is the kind of thing that we're facing now. Once again, markets, they're listening to headline risk, which has been in stark contrast to what we've seen over the last 2 years. All right, one last look I want to give you at, just bias for the marketplace has something to do with the VIX. And no, it has nothing to do with the VIX chart. Like, I know a lot of people are going to examine the VIX chart. Well, the VIX was here and now it's here. Let me show you what the options pricing is saying inside of the VIX. So we're going to open up the 41-day options. All right. So it's the April 41-day options. And I want you to look at the at-the-money options. Now, the at-the-money options right now are right around the 18 strike. So you can see the VIX closed 1776. The 18 strike is pretty much the at-the-money strike. And I want you to look at the price of the calls versus the price of the puts. For the most part, they're equal, right? Because the marketplace kind of prices things as equivalent. The chances of us going up about the same as the chances of us going down. Great. However, there is a huge skew inside of this market. I just want to show you how the market still has this tremendous and underlying fear. And you can see this in regards to the pricing. So if you look at the at-the-money call and the at-the-money put, again, they're trading fairly equivalent in price. Let's just go like $3 or $4 out of the money. What's $4 out of the money? So it's 18 plus 4. Let's get crazy and call it the 22 strike calls. And then 18, for instance, minus 4. Let's go down to the 14 strike puts. And look at the pricing differential. The puts are trading roughly for what? 30 cents? What are the calls trading for? Calls are trading for right around, let's just put it at about $1.20. Okay, that, people, is indicative of a monstrous implied volatility skew. Okay, so the marketplace right now, when you're looking at it, it's just simply saying like, hey, the risk is still very, very progressive, and it is to the downside in the S&P. So they're actually saying the risk, all right, the VIX is still very capable of exploding, even though the volatility has contracted in the VIX, okay, quite substantially. The chances of us actually rocketing back up are still being priced in the VIX, which again is indicative of the S&Ps seeing more sell-side activity. Now, whether that comes to fruition over here is neither here nor there, but again, the goal of this evening's video is to show you, number one, get your risk in check. That Nasdaq, okay, margin requirement, the S&P margin requirement, they're up there. And they're denoting that even the exchanges themselves are screaming, risk is here, risk is prevalent. Again, if you don't need that indication, look at the VIX, okay? Lastly, keep an eye, again, on that dollar. It's $DXY. Any rally to the upside in the dollar looks like it's probably going to be another leg lower in the S&Ps. Very likely we get some wild action into the end of this trading week. Thanks everybody again for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.